So welcome everyone. I'm delighted today to welcome you all to our third Fund Manager Q&A webinar of 2021. I'm joined today by one of our longest serving management teams, Nick Purves and Ian Lance from RWC Partners, who are managers of our equity income fund. The excellent compounded return and strong inflows into the fund have resulted in that being more than £2.5 billion now in size across all of our wrappers. Everyone on here will, I'm sure, be aware of the returns over the last 6 months and the turnaround from where we were this time last year. We will touch on this and a lot more besides. Hopefully you will all have seen the client-facing video that was recently uploaded onto your partner websites, which touched on a couple of topics, but today will be covered in a bit more depth for you, the partnership. I'm sure you'll all be used to this format by now and are aware of how we would like these sessions to work. All the questions I ask have been submitted either before or during the event by partners, and you can submit further questions via the Q&A section at the bottom of your screen. If there's anything you're hearing from clients, pop that over to me. I'll make sure we get through as many of these as possible to make them as helpful as possible in your client conversations over the coming weeks. I've got plenty of screens open here, so you'll see me looking around, but all questions will find their way to me. For those questions we don't get a chance to ask, we will do our best to get these answered and follow up directly with you. So let's get into this. Nick, Ian, welcome. Thank you for joining us as we all continue to work from home. While we give people time to submit their questions, a nice simple one to start, and I don't mind who takes this. Can you give us a brief synopsis of what happened in 2020 and the start of 2021?
Yeah, sure. Where to start? I mean, obviously it's been an extremely volatile 15 months or so, obviously sparked by coronavirus and the ensuing lockdowns. And I think I suppose the way to think about it is that, you know, what coronavirus and the associated lockdowns have done is essentially impart a significant deflationary shock to the global economy. And whilst obviously it looks as if, you know, economies are recovering right now, obviously they're recovering from a lower base. When you get a shock such as the one we saw in the spring of last year, immediately what happens, of course, is that investors become fearful, understandably, because obviously level of uncertainty has increased very dramatically. And when investors are fearful, they sell down aggressively those assets which they think are most likely to suffer as a result of coronavirus and the lockdowns. And so, and of course, you won't need me to tell you, obviously in the spring of last year, you know, really in February and March of last year, we saw very, very significant declines in equity markets everywhere, with the falls in share prices most marked in those companies and sectors which are most likely to be significantly affected by coronavirus. So the more economically sensitive areas of the market, such as financial, so banks obviously, or energy companies. And you'll remember roughly a year ago, the oil price went negative briefly, didn't it? And so, you know, a lot of stocks in those areas falling by 50% or more. Obviously, difficult to generalize. And what you'll know as well enough to know, we're long-term investors, and what we try to do is we try to actually take advantage of that volatility and the fact that investors, when they're fearful, have a tendency to sell shares at way below their fair value. We try and take advantage of that volatility for the long-term benefit of the fund. And so we actually, although, you know, we mustn't belittle it, obviously, because volatility is uncomfortable. It's uncomfortable for the partners. It's uncomfortable for the end client, clearly. But those periods really do provide an opportunity, we think, to as I say, buy into deeply undervalued companies at very good prices. And so what effectively happened last year, in about this time last year, is the level of turnover in the portfolio went up quite dramatically. And we quite aggressive, because our level of portfolio turnover tends to be pretty low. So at times like last year, and we saw this actually in the financial crisis going back a few years as well, at times like the one we saw in last year, the level of turnover goes up, and we quite aggressively, certainly for us, rotated the portfolio out of those companies where the share prices had held up really well. And we weren't saying that they were those companies were overvalued. It's just that they didn't offer the long-term opportunity, because they offer predictability and safety today, and therefore investors were quite fully pricing those shares. And we recycled that money and put it, and as I say, for us, quite aggressively put it into companies where we saw extreme long-term undervaluation. And we think that, we try and form, when we're moving money, we're investing money in a company, we try and form a view of what we think the long-term earnings power of the business is. And if we can buy business at, let's say, less than 10 times its long-run earnings power, we think we've got a bargain. Well, such was the level of fear in the market this time last year, we were able to get into companies, we think, on around 5 times their long-run earnings power. Think what that means. So a PE of 5, price earnings ratio of 5, that's an earnings yield of 20%. If we're half right about what the profits of these companies might look like in a few years' time, as and when the coronavirus has basically passed through the system, then the fund should be very, very well positioned for the ensuing recovery. So we rotated pretty aggressively this time last year. We then, didn't we? We trundled through the summer. And then, of course, in the autumn of last year, November last year, we got some wonderful news, didn't we, about the vaccines. And, of course, that gave the market, if you like, the excuse that it needed to start looking forward, to start thinking, actually, do you know what? We will get on top of coronavirus. Some sort of normality will return. We don't know exactly when, but it will return. And the profits of a number of these companies can actually return to some sort of normality. And of course, as you know, that when the stock market thinks it spots a change in the outlook, if you like, it moves very quickly and aggressively to reprice or price in that new reality. And it's at that point, it's really in November, December, and running into this year, that we're really reaping the benefits of those investment decisions that we took in the spring of last year. Because, I'm sure the fund is up around 70% off the bottom we saw in March. Even if if you're, let's say, man from Mars, and you never even heard of coronavirus, and so you're looking at, let's say, the period from 1st of January last year, so stripping out obviously the falls, as well as the fund is actually done well over that period as well. So the fund is, I think, it's up small positive in index, which is still down between 5 to 10%. And what's more than that is that you've still got a portfolio today which we think is exceptionally underpriced, and therefore has the potential to give you some pretty stellar returns from here. So it's a long-winded introduction, but obviously it's been an eventful period. But the volatility has been uncomfortable and scary, but it really has provided us with an opportunity which we think we've managed to take advantage of.
I think it's a crucial point you make about holding on, and I think the 3-year figures for the fund now are comfortably ahead of benchmark. The longer this bounce carries on, then the more effect it will have on the longer term fund comparisons as well. Slightly moving on. I mean, there was a reason we covered 2020 up front, was so that we can stop talking about 2020, because most people are pretty sick of it by now. But I think it's something that has to be done anyway. It does feel to me like there's a lot of talk about value versus growth. It's an easy go-to subject for a lot of market commentators nowadays. But it feels to me like a lot of value managers spend most of their time being told they're wrong, which I can see you both nodding straight away there. Given the discipline around it, can you give a bit of background as to why you in particular believe that a value style is still the way forward, and have managed to keep that discipline for the last few years, when you will have been told constantly by a number of people that you were wrong?
Yes, let me take that. Maybe I should just start by, defining what exactly is value investing. At its simplest, it is the act of wanting to buy something for less than it's worth. So we will often refer to a business as having an intrinsic value. We're aiming to buy that business for probably half of its intrinsic value. There's a very good book about investing, about value investing, and it's entitled Simple But Not Easy. And of course, the simple part is what I've just described. Of course, who doesn't want to buy something for less than it's worth? The not easy part is the fact that typically you only get to buy those things for less than they're worth when there is some period of dislocation. There is bad news. Lots of people will be telling you that this company has lost its way, it's a structural decliner, or the economy is in a bad position, and so you're actually buying things in a torrent of bad news. And that's the difficult part of it. But if you actually can exploit that to your advantage, then it does throw up these wonderful opportunities. And I think Nick has just given, probably one of the best examples of that in the last 20 years, of describing last year. We had that huge dislocation in the markets. If you are able to extend your time horizon and look forward, then it threw up some amazing opportunities. Why are we value investors? We're value investors because there's an awful lot of proof that it works in the long run. I guess if you look at our long run returns, that is evidence of that. We have never bought into this idea that value investing is dead. Why? Because value investing, the opportunities brought about by value investing, but simply brought about by people's behavioural biases. It is the fact that Nick described earlier on, that during times of uncertainty, people become scared. They sell businesses, cyclical businesses, for less than they're worth, and they will buy more defensive businesses at very high valuations. And those traits have not gone away in human beings. Human beings are going to do that probably forever. People are not going to become sort of completely rational ever. And so we see no reason why those traits should disappear, and therefore why value investing shouldn't continue to generate good returns in the future.
Indeed. So the questions are coming in thick and fast now. So let's dive into a couple of those. This is something I thought would come up, and it's come up a couple of times already. So I'm going to group these together. BP and Shell make up around 10% of your fund. How do we marry this up? This is something we touched on in the client-facing video recently recorded, but we can go into a bit more depth because we've got the time now. How do you marry up the ESG principles that we're asking you within the funds to have, and having such large amounts in oil companies? Because that's something clients will bring up quite a lot with the partners. So, I mean,
there are obviously various criteria which companies have to fulfill in order to make it into the portfolio. We've talked about valuation. Obviously, starting valuation is extremely important, but sustainability is also extremely important to us as well. I mean, there's no point, is there, in buying a cheap asset, in inverted commas, if ultimately it's not a sustainable business. Because ultimately, if it's not sustainable, it will decline. And how can you, in the long run, make money out of what is essentially a declining asset? So we will only invest in sustainable businesses. Okay, so, and obviously the word sustainable has different connotations perhaps in different sectors. in the context of the energy sector, it's can the companies do what they need to do with regard to carbon emissions in order that we as a society can meet the stipulations of the Paris Climate Change Agreement, which is designed to ensure that global temperatures only rise by, well, between 1.5 and 2 degrees from pre-industrial times. And companies everywhere, aren't they, and governments as well, are basically putting out, they're articulating their ambitions to basically get to net zero. I believe that in the UK, we've said, the UK government has said it is our ambition as an economy to get to net zero by 2050, because that is the current thinking, is that is where we need to get to in that sort of time frame if we're going to do what we need to do to keep carbon emissions down. Well, the energy companies, all of them, well, certainly all the ones in Europe, and certainly BP and Shell and Total, actually, which you also have exposure to in your portfolios, each of them have articulated their roadmap to net zero by 2050, with various different staging posts along the way. And they will do that. The levers that they will pull to get to there will be, there are a number of things that they need to do. They will be altering their energy mix, so they will be improving the mix in favor of natural gas away from oil, because natural gas is the cleanest of the fossil fuels. Within gas, more and more of it will be what's called abated natural gas. So that will be natural gas with the carbon removed. They will be investing heavily in renewables. They will be developing carbon capture and storage technologies. So they've got a very clear idea as to how they intend to get to net zero by 2050. And so our view is that these companies can be part of the solution, not part of the problem. So you can invest in these companies with a clear conscience. It's nonsense in our minds to think that if you believe in the green economy, which I think we all do, that you can only invest in green energy stocks. That's just not the case in our minds. So with the energy companies, you can invest at a low valuation, which is good for future return, and you can invest in a clear conscience on knowing that they have got a clear agenda to get to net zero by 2050.
I think that is a question we get quite a lot. I've had a number of questions asking where this client video is. It was placed on all partner websites on the 11th of March. It's called UK Equities: Why They Offer the Best Value in Decades. And in there, you've got a little 12-minute video that you can show your clients, or they may well have already seen. So yeah, please take a look at that. If not, contact me afterwards and I'll send you a link to that.
Darren, actually, sorry, can I just interrupt? Can I just make a further point? We would absolutely, perhaps not our remit, but we would caution against the amount of money that is being invested in the green energy space. And of course, the amount of money that's flowing into those areas will naturally depress returns. We think that our understanding is that green energy projects today have been bid up to such an extent that the imputed return is around 4% on those types of projects. And that, even making perhaps some quite optimistic assumptions about how those projects pan out. So, there's two messages here. There's one message. Number one is that the integrated energy companies can be a good investment, and it's a warning shot eventually essentially about some of the valuations that we now see in the hot green energy space.
On a slightly different tangent, I'm going to group up a couple of questions as well on this theme. So forgive the long question, it's two and that I'm putting in one. So when it's crystal ball territory, I'm afraid. When do you believe a return to normality for dividends will occur? And I'm going to put normality in inverted commas for you there. And what do you expect normal to be? Who wants that one?
Yeah, I'll have a go at that one. You're right. It is slightly glass ball because at the end of the day, dividends are set by boards and they can do what they want when they want to a certain extent. I guess we would tend to look at sort of past experience to be a bit of a guide to this. So if you go back to the financial crisis, obviously, we went into the financial crisis. Lots of companies cut their dividends. Caution was the watchword, just as it was last year. And so people, the first thing that companies will do is cut dividends, and then they'll sort of wait for a while and see what happens. And actually, if things turn out to be better than expected, then you can see those dividends start to come back quite rapidly. And we suspect that's likely to be the case over the next year or so. When we went into lockdown last year, there was just huge uncertainty. Companies didn't know how long it was going to last, how deep the impact was going to be. And naturally, people do they want to grab liquidity to make sure that they have sufficient liquidity to survive any rocky period. Cancelling the dividend or cutting the dividend is one of the quickest and easiest ways to do that. But I think looking forward, it looks likely that we're going to get quite a strong economic rebound this year. That things are going to come back, and one would expect dividends to come back. Now, of course, that's not going to be the same across all industries. Airlines are not going to be paying dividends this year. But I think if you look at the market as a whole, one might expect dividends to come back. Energy companies, really good example actually. They obviously did cut their dividends last year, but actually at current oil prices, they are generating significant amounts of cash flow with which to pay dividends. Banks is another interesting example. They probably didn't need to cut their dividends last year, but they were forced to do so by the regulators. The regulator, of course, is now tentatively stepping back from that and allowing them to pay dividends again. So I think the expectation is that dividends will come back, reasonably robustly in the next couple of years.
And I'm only going to ask this one because you mentioned that. You mentioned airlines there. We've already had somebody asking what your views on the aviation sector as a whole is. When do you think you might fancy dipping your toes in that? Is that soon, or is that a while away and a few bumps in the road yet?
We actually think that obviously the market is trying to price in an economic and therefore profit recovery into a number of different sectors, and it's doing it. It seems to be doing it at different paces. And there are some companies out there actually where we think that the market's possibly being quite generous, i.e., it's assuming that the recovery and profits is more robust and happens more quickly than we think perhaps is likely. And actually, it's interesting you should mention airlines, because actually we think that the airline sector might be one of those. I think what we don't have any, your funds don't have any investments in airlines, really for that reason. And I think it's very difficult, isn't it, to there'll be some companies, a good number of companies out there for whom coronavirus has been a sort of shocking and difficult experience, but ultimately in, let's say, two years' time, their businesses will just go back to being what they were in 2019, say. And I think there are other businesses out there where the scars are going to take a lot longer to heal, because there's probably been, or there probably will be, a fundamental change in consumers' behaviour. And it could be that the airline sector is one of those. Now, you probably know the airlines tend to make almost all of their money out of selling premium and first-class tickets, and that tends to be to business travellers. And therefore, anything that, if business travel doesn't recover in the way that perhaps it doesn't recover to where it was in a reasonable time frame, then that could actually be very damaging to the long-term profitability of the airlines. And yet, actually, the stock market, we think, has actually possibly in these stocks got a bit ahead of itself and is perhaps pricing in too vigorous a recovery too quickly.
Because we're on that subject with airlines, I think somebody overnight sent me an email about the UK retail industry, which has certainly not been without its problems as well. Probably even pre-COVID, we weren't exactly saying it was a hotbed of opportunity necessarily at that point. Marks and Spencer's plays a significant part in your fund. Can you talk about how you see UK retail right now?
Yeah, let me talk about that. Again, I think this is it's another one of these areas where you get opportunities thrown up, but because people tend to not differentiate between different retailers. So people tend to, I think, just think, lockdown bad for retail, and sort of the whole retail sector goes down. And the reality is actually that for some companies, it wasn't just neutral; it was good. So if you look at the companies within the portfolio, Kingfisher owns B&Q. Actually, they have had a fabulous year last year. So that's one. And actually, the shares have done very, very well. Another one is Dixon's Carphone, which again, although a lot of their stores were closed, obviously they have a huge online offering. And so actually, and of course, we're all now sitting at home. We're all ordering, extra screens and laptops and so on and so forth. So again, lockdown was actually not a bad experience for them at all. And I'll just add there actually that they're another one of these companies where I think people often think that they're the sort of company that might struggle against an Amazon or the big online giants. And again, the reality is actually that they're not. They are, they have a higher market share in UK electrical retailer than Amazon does, and they have a price match product. They will always match Amazon on price. So actually, they have they fared very well. And then coming to Marks and Spencers, of course, that's an interesting story because people tend to focus in on the stores and particularly clothing and home. And clearly that was very difficult. Lots of their stores were closed last year, so no getting away from that. But again, I think what people maybe don't look at enough is the fact that even if you go back a year or so ago, 2/3 of their sales were actually coming from the food business. And you might remember that they did that deal with Ocado, which started last year. That has started very, very well. And again, because of course we're all now ordering food deliveries online, that business has performed very, very well. And we basically believe that if you value their food business on the same sort of multiple that you would value a Tesco's or a Sainsbury's, the UK retail business is actually not just in for free, but in for a negative valuation. So investors are ascribing no valuation to that at all, despite the fact that it's still the number one closed retailer in the UK market and actually still has a very significant online presence. So, a kind of mixed experience, but we do think there are opportunities in the sector if you're willing to be selective.
And it's that active management argument again, isn't it? It's why dismiss a whole sector when there may be undervalued businesses, isn't it?
Exactly right. That's exactly right.
Yeah. So questions are still flowing in. I probably need to at this point address the fact that there may be questions coming in that I will have to take separately. I'm not going to ask about portfolio construction to fund managers. I'm not going to ask about Neil Woodford because he's come up a couple of times, so I don't think that's fair. So anyone sending that, by all means, email me. 2 people have actually emailed me saying a question that isn't appropriate live, which I haven't read yet. So these are coming in, and the rest of my day seems to be doing those, but that's fine. I'll stick to the relevant ones. Look, while we're doing sectors, somebody's pointed out that around 20% of your fund is in financials. How much do continuing low interest rates worry you?
I'm glad. I'm glad you asked that question because it's important that we get a chance to address that. I think you just got to be clear to start off with. So obviously, our ultra low interest rates. We're really talking about the banking sector now primarily. Our ultra low interest rates bad news for banks to the extent that all other things being equal, they compress net interest margins. Yes, absolutely. They ultra low interest rates make life more difficult for the for the banking sector. And again, just it's important just to reflect on where we've come from. If you go back, I know this is a long time ago now, but if you went back pre-financial crisis, banks would make a return on equity of between 15 and 20%. And they would do that. They were able to do that for two reasons. One is because they were able to run for a long time anyway with imprudent levels of leverage. They were able to leverage up the assets to what turned out to be obviously unsafe levels. And of course, they're clearly not allowed to do that anymore. And the second factor is that obviously, I mean, do you remember the good old days when the base rate was 5.5%? The interest rates were a lot higher then. So, and obviously interest rates are a lot lower today. And just again, be very clear about this. We do not have any view, if you like, on where interest rates are likely to be in 2-3 years' time. We just don't know. So when we're making our assumptions, if you like, when we're trying to value the businesses, we have to assume, therefore, that interest rates stay at ultra low levels, and that's what we do. And assuming that interest rates do stay at the low levels of today, well, then I can assure you that the returns that the banks generate are not going back to where they were 15 years ago. So there has been a step down, if you like, or we assume anyway, there has been a permanent step down in the level of returns the banks can generate. Does that mean that you can't invest in them? No, absolutely not. What it means is that you need to price them, if you like, or value them for the new reality, and that's what they do. And actually, because where are we now? At end of March, all the companies. So you hold 3 banks in your portfolio: NatWest, Barclays, and Standard Chartered, and all 3 of them in their year-end results, which they announced in February, reaffirmed their return on equity targets. All of them assuming that interest rates stay where they are, and they've all talked about return on equity target of around 10%. And you might think to yourself, well, how can a bank, when interest rates are 0, how can a bank make a 10% return on equity? Well, there are various forces at work. One is, don't forget, is that no one gets that 0%. If you go and borrow for the bank, you go and take out a mortgage. And by the way, mortgage demand is very high at the moment because obviously the housing market is quite strong. You'll pay a spread over that of around 2%. So actually lending spreads actually continue to be okay. Second point is that, of course, not all of their income comes from net interest income. A good portion of it comes from fee income, or if you're in the case of Barclays, it might be trading income. And the other factor to think about, of course, is don't imagine that these companies just sit there whilst their returns are being eroded. They, of course, are constantly changing. And the way that we all interface with our banks has changed enormously, even over the last 5 years. And of course, that allows the banks to use effectively technology or advancements in technology to take out a lot of costs. They run with much lower costs today than they did a few years ago. So return on equity targets of 10% are achievable in relatively short order. A company with a 10% return on equity should trade at around book value or equity value, however you want to describe it. Today, the banks trade at around, well, it varies, but between 0.5 and 0.7 times their book value. So obviously, Standard Chartered, which is at half book value, that goes to book value. That's 100% upside in the shares. I mean, you can do the maths as well as I can. So I think it's just we're trying to demonstrate is that we don't just sit there. Value investors can be accused of being dogmatic. They just sit there and assume that nothing changes. Well, of course, the world's constantly changing, and all these industries are changing. But you always have to try and price companies on the basis of the new reality, whilst trying to make some relatively conservative assumptions.
I think because we're on the subject of financials and it's 36 minutes and nobody's mentioned the B word yet, Brexit, somebody has just asked about it. So one of the consequences of Brexit is that other financial centres in Europe seek a greater share of the market. Do you see this as a threat, in particular to new UK listed companies, or indeed the universe that you're currently invested in?
No. I mean,
Short answer.
NatWest is exclusively operates in the UK.
Yep.
It's purely, essentially, it's purely a retail bank. Standard Chartered is exclusively outside of Europe and the US. It's in developing or countries, so it's not affected by Brexit and a change and a sort of shifting pattern when it comes to the preeminent financial centres. And then Barclays, of course, is an investment bank. Actually, Barclays the most important market probably for Barclays is actually the US investment banking market. So, I mean, I'm not being complacent or dismissive, but actually for the three banks that you hold, Brexit is not an issue.
Could I just add a point to that? Is we would really encourage people to think about what is priced in to assets or companies, and might the future actually be sort of better than what is priced in? And Brexit is a good example of that, because as I think as it's shown in that note you referred to earlier on, that the UK is trading at the biggest discount to MSCI World since the 1970s. So literally you have to go back 50 years to get the UK this cheap. If you actually look at the chart, it really, that discount widens out in the last 5 years. So undoubtedly that was, I think, concerns about Brexit. And I think we can probably say now that actually, although we don't exactly know what the future is going to be, the impact is going to be positive or negative or neutral, we think the boundaries have come in a lot. So I think a lot of the risks of it have been taken away. So that's an argument for I think for UK equities, and I would just kind of make the same point with banks as well, actually, because what investors are doing there is they're pricing in, I think, this idea that inflation will stay low, that interest rates will stay low. And actually, if you look at what's going on in markets at the moment, there's actually the markets are beginning to, I think, get slightly concerned that inflation might creep up in the future. Just look at commodity prices, the recent rise in bond yields, inflation expectations, etc., etc. Now, of course, the banks will perform well in that environment. You do need something in your portfolio that actually would perform well in an environment in which inflation ticked up and yields ticked up. So, as I say, I would just encourage people to sort of think about, what's actually priced in and how might the future actually be different from those expectations.
And in terms of, you mentioned inflation there, which then leads on to interest rates, which then indirectly leads on to a currency question, which I'm going to put to you. How much notice do you take of the exchange rate? Is that, within your process, is it something you're keeping a close eye on minute by minute, or is it something that you see as incidental over the long term?
We really see it as incidental. I think if you look across the portfolio, although of course the majority of the companies are UK listed, a lot of them have got sort of wide diversity of exposure to different currencies. So that's the first thing. Probably if you look across the portfolio, a lot of those currency exposure are offsetting each other. But the second thing is that we have no skill whatsoever in forecasting currencies. Well, we're never going to build a portfolio around a view of a particular currency. Or the only thing we will do is make sure that we don't have an undue exposure to any one particular currency, where implicitly the portfolio ends up becoming a currency bet. So we obviously avoid that.
I think one fund manager said to me once, it's hard enough to get the market right without trying to get the currency right as well. So I think that sums it up. Look, I'm conscious of time. There's probably about 10 minutes left, so I'm going to get through as many as we can. Your performance, when you look at the returns, the performance looks quite cyclical over the last 10 years. Do you see this the way that your fund will always operate, with some quite punchy years, etc.? What are your views on that?
Difficult one to answer. I mean, broadly, Going right back to the beginning, we're value investors. We try to, when there's a dislocation in the market and we sense that other investors are being too fearful, we will obviously try to take advantage of that. And so most of the time, these opportunities arise, the best opportunities arise as a result of what we would describe as extreme risk aversion. So there's that cliche, isn't there? Be greedy when others are fearful and fearful when others are greedy. And I think I know it's cliche, but it is nevertheless true. And we try to be greedy when others are fearful. And that was the case last year. Most of the time, our best opportunities will arise in a time when most market participants are adopting a very risk-averse stance. Now, the reason the question is the answer is more nuanced, perhaps, is because if you go back to the three big dislocations we've seen in our investing career are today, the global financial crisis, and the TMT bubble in 1999-2000. That was a weird one because actually the opportunities then, and the market was extremely dislocated then, but the opportunities didn't arise because investors were fearful, if you like, of the so-called old economy stocks, which is obviously the ones that we were invested in. It's just they didn't have, those old economy stocks they weren't sexy and attractive. They didn't have the go-go growth opportunities that actually investors really craved at that point in time. So you could say that actually those opportunities then arose because investors' appetite for risk elsewhere was too high, as it turned out to be. But broadly, I mean, most of the opportunities that we see will be as a result of risk aversion, extreme risk aversion, perhaps by market participants, and that extreme risk aversion tends to be in the more cyclical areas of the market.
Actually, can I just add to that, Darren? Because I've just got up here the chart of I know you can't see this, the chart of performance of the equity income fund. And the point really that I'm making is that when these opportunities come about, actually the outperformance that follows them is pretty significant, but it's pretty enduring. So to give you some examples, post TMT, actually the outperformance lasted for 5 years. The fund did 58 versus 12, basically. Post financial crisis, again, it lasted for about sort of 5 or 6 years, and it was sort of 68 versus 38. So that not only is the outperformance quite significant, but actually it doesn't happen overnight. Typically, it's something that endures. You almost have a regime change in the market. You go from one regime where everyone loved growth and hated old economy or value or whatever you call it. You get this regime change, and it lasts for years. It doesn't go away overnight.
And I think any partners on here listening and who've got analytics, the equity income fund, there's plenty of backtested performance on there that you can see post market falls, that you can see for yourself how this fund generally does. I also said I wasn't going to go near portfolio construction in this, but I feel the need here to say when we are constructing portfolios, we do take volatility and volatility of returns into account. So it is something that when we are creating risk-rated portfolios, we are taking this kind of thing already into account. So it's not necessarily something that we ask fund managers to be concerned about. If we had that much concern about it, we need to blend it with funds that don't. And that's part and parcel of the process that we go down along the way. Look, as usual, when I say that we've only got 10 minutes left, I then get a raft of questions in. So look, I'm going to keep going for another 5 minutes. So I apologize if this is overrunning slightly. But I think the first one here is quite important. Royal Mail is by far your top holding, and it stands out on the fact sheet as such. So can you talk a little bit about Royal Mail, because that is a stock that's been through the miller for the last few years, isn't it?
Yeah, I mean, Royal Mail, a great example of where obviously the fear in the market that we saw last year meant that investors basically threw the baby out of the bathwater. And I think what's been especially spectacular, I suppose, about Royal Mail is the fact that what was initially seen to be a coronavirus loser actually has been a coronavirus winner. Because I think when you say, I think the biggest problem with Royal Mail, we said this to the management, is that the company's name is wrong. You say to people Royal Mail, they say to you letters is in decline. That decline is only accelerated as a result of coronavirus. How can that be a good investment? And what they're missing, of course, there, and that was the view that the stock market was taking early last year. The shares got down to just over, I think they probably started at 250, and they probably got to just over £1. Just over £1, by the way, at the lows, the company was capitalised at it was valued in the market just over £1 billion. What that narrative, of course, was missing actually is that the large majority of Royal Mail's revenues come from parcels, and parcels have parcel volumes have gone up enormously. They're up between 20 and 30% over the last year. Obviously, because we're obviously doing a lot more shopping from home, and you probably don't know, I'm sure we don't know this. Royal Mail has got a 50% market share in UK parcels. They've also got a well-operated overseas, exclusively overseas parcels business. Such has been the boon for the company of coronavirus. So the company's got a March year end, and in a year just about to end, it's expected that the company will report 700 million of profit. Remember what I was saying, it was capitalised at just over £1 billion. So you were able to buy into this company at less than 2 times profit. So you had a payback of less than 2 years. And so it's just extraordinary. Now, of course, the market has now woken up to the fact that the coronavirus, it provides actually an opportunity for the company, and the shares have done very well. So they're over £5 now, and they're up 300 or so percent from the bottom, and have probably doubled since this beginning of last year. But actually, we still think that, weirdly, we still think there's value in the shares. It's capitalised there at around 5 billion for a company that's making 700 million of operating profit with a 50% market share in parcels. That's actually not a bad place to be. So it's been an extraordinary period, and we've again, a great example of an opportunity, how that volatility created opportunity, and we were able to take advantage of it.
And that's a useful explanation of why you've got such conviction in that, and why it's such a significant holding in the fund. That's exactly what most clients and most partners will want to hear on that. So I really, really appreciate that. Look, for both of you, it's really difficult to provide views on absolutely everything in the space of 45 minutes. But I appreciate how you've managed to go through such a wide and varied number of issues in that time. Unfortunately, we've come to the end of the session, but no, I truly appreciate how you've answered these. I know it's not an easy task with our partners sometimes. Any questions we haven't got to for the partners listening, we will get the answers and collate those for you. So any feedback, good, bad, neutral, let us know. Good ones, let me know. Bad ones, let Nikki know. If you let us know which particular managers you would like interviewed in this format, the next two after this will be Clyde Russo for the Worldwide Income Fund, and due to partner demands, Sunil Thakur from Sands Capital from the Global Growth Fund. So all questions you want posed, gratefully received in advance. Thank you to Nikki, Georgia, for putting this together again. Thank you for Nick and Ian for being so honest, taking the time this morning to speak to us. And thank you all for dialing in. Stay safe, stay well, and hopefully see you all again in a few weeks' time. Thank you.
Thank you.